Are you going to be liquidated and lose all of your crypto? That depends. So that's what we're going to talk about today. We're going to talk about basically leverage trading, futures trading, and essentially how that works as opposed to what's called spot trading. But I'm going to explain it because I've seen people talk about, and at least I see posts on X and that sort of thing. They've been liquidated. They lost all their money. And I think some people might be freaking out. Is that going to happen to them? Well, if you look here, this is a site called BitUnix. I'm going to use this one as an example. I'm Brian. I'm a big dumb animal. Don't do what I do. Informational purposes only. I'm going to explain it so you understand it because you might be interested. Do I do it? I do, but I have my own rule, and I'll explain my rule at the end and why I do it. All right. So let's just talk about, in general, there's spot trading and there's futures trading. Oh, by the way, please like if you like these videos, subscribe. I got a school community where I have courses teaching all this kind of stuff. And this is BitUnix. I actually have a link down below, which is an affiliate link. You sign up, I can make money off that. Anyway, 2 ways to buy crypto. They call it spot. Spot just means that you're actually buying that crypto and you're holding it. You take $100. The crypto is $1 a token. You're going to be able to buy 100 tokens. You hold them. Now, they might be held on the exchange or you might put them in a wallet, but regardless, you have control of those 100 tokens, meaning when they're sold or not sold. If it goes up or down, you're deciding when to sell. You don't lose money until you actually sell. Okay, that's spot buying. That's what most people do. Up here, you'll see it's called spot. Then there's one called futures. Now, on something like BitUnix that has futures, they will have essentially 2 different wallets. One wallet is your money that you use to buy spot and hold it. The other one is your futures wallet. And the reason they do that is because on the futures, you're buying on margin. And it may matter what's in there, and I'll explain. So now you know that if you're buying spot, you're not going to be liquidated. Now with futures, what is actually happening? Well, in futures, you're controlling with leverage more than you would be able to control if you bought it. So here's the example, and let me just show you. We're in the futures right now. You can choose any type of crypto you want to look at. We'll just leave it here on Bitcoin. Here's the chart. On the right-hand side, 3 things to note. I'm going to keep this very simple. The type of margin, isolated or cross, and then how much leverage. Green here is leverage for a long trade, and that's leverage for a short trade. And then you can open a long trade or a short trade. We're just going to talk about a long trade. And let's first talk about an isolated margin with a 5x. So here are the basics. Let me throw up this example so you can see it. Let's say that you have $100 and in your futures wallet, and you're going to buy $100 worth. And with 5x leverage. So with 5x leverage, it means that you're controlling $500 worth. So simple math, let's just say that it's $1 a token and you have $100. Now, you know, if you bought that spot, you'd have 100 tokens. If that goes up to $2, the token goes from $1 to $2. You invested $100. If you sell it at $2, you now have $200. Okay, so you made $100 profit. With futures, with 5x leverage, for example, you multiply it by 5. So your $100 is essentially getting you $500 worth of tokens. You're thinking, well, why don't I just do that all the time? Well, I'll explain in a moment. That's where liquidation comes in. So now if the token goes from $1 to $2, well, you actually are controlling 500 of those tokens. So you're going to be able to sell it and make a $500 profit because it went up $1. You had 500 tokens. Excuse me. So you made a $500 profit on $100. In spot, you would have just had a $100 profit. So that's the power of leverage. It's allowing you to control more. Now, here's the downside and the risk. The risk is what they call liquidation. That means that the exchange is going to sell out your position without your approval. If it was spot, they couldn't sell your crypto. But in this case, they can. Why and when would they do it? You put $100 in that futures account. You only have $100. So you're controlling $500, all right? Now you're doing a 5x leverage. So you take 1 divided by 5, you got 0.2 or 20%, which means if the price were to drop by 20%, then you're going to get liquidated. So you bought at $1. If it keeps going up, you're good to go. Not going to be liquidated because you're in profit. If the price starts dropping 90 cents, 85 cents, as it gets closer to 80 cents, and there's this other margin requirement rule that they have, but they're going to sell it right before it gets there. Because why? If the price were to drop to 80 cents and you're controlling 500 of those tokens and you've lost 20 cents per token, 500 times 20 cents is $100. You have $100 in your account. So they're going to stop it as soon as you're lost, because if it were to go less than 80 cents, say 70 cents, that's another 10 cents per token, but you only have $100 in your account and the loss is more than that. Well, who's stuck paying the bill? The exchanges. Do you think the exchange is going to get stuck paying the bill? They're not. So they're going to close that out immediately and your position will be gone. And they're doing that to cover themselves. So if you were to do a 10x leverage or a 20x leverage, you can see the liquidation price changes because you're controlling a lot more. So the more leverage you do, the closer that liquidation price is to the price you just entered at. So hopefully that makes sense. In that example with a 5x, 1 divided by 5 is 20%. The price drops by 20%. You're going to be liquidated. That's the downside. That example was what's called an isolated margin account. So on BitUnix, as you noted, up here it says isolated. So that means that you put $100 in and it's going to use just that $100. So when it gets a $100 loss, you're liquidated. Now you can actually go in and add to that margin. So if you wanted your liquidation price to be dropped a little bit, you could add, say, $20 to make it $120. You're not controlling more, but you are dropping your liquidation price. And if it goes your way, you'll get that money back. Okay, so that's an isolated margin. You could, let's say, open 5 different futures contracts. Maybe you've got Arrow, maybe you've got Ondo, maybe you've got Bitcoin, and they're all isolated. So you put 100 into each. 2 of them do well, 1 doesn't. 1 gets liquidated, the other 2 continue to run. Now, this other one, if you do this drop down here, it says cross. What does that mean? That means that it will use the extra money in your margin account. So let's say you put $200 in your margin account. And in this example, you used $100 to open that futures contract. You still have 100 sitting in your margin account. So if it drops down, that particular one goes less than 80 cents. Normally, if it was isolated, you'd be liquidated. But in this case, it looks and says, oh, you still have money in your margin account. We'll let it drop a little more. Of course, it can only drop until you're out. Where that can be valuable is if you've got extra money in that account and you open multiple futures contracts, Arrow, Ondo, Bitcoin, and you have extra 100, 100, 100, maybe you have $1,000 sitting in your account, they can actually help one another, meaning one of them starts going up, it actually gives you essentially more margin. However, the downside is in some cases, you're expanding your risk because now you're putting at risk that extra money you had sitting in your futures. So for me, I really prefer just to do isolated ones. It's just easier for my lizard brain to realize if I put in 100, I could lose 100. I'm not going to lose more because I have extra in my account. The other thing I didn't click on, and I'll show you here with this drop down, it pulls it up and you can do what kind of leverage do you want. This is for a long versus a short. We're just talking about longs. I've got it set at, you can do 1, which makes no sense, but 2, 3, 4, 5, and it goes way up there. Very dangerous the higher you go. So I told you I would, and then down here, the bottom is where it's going to show you your open futures contracts. I closed that so you don't have to see all of mine. So leverage is dangerous. I don't recommend it, but here's what I do. I have my own rule. I always put rules on myself because when you're in the heat of the moment and things are happening fast, I like to have my own rules. so that I can kind of control my stupidity. My rule is essentially this, real simple. Take 1,000,000 small bites instead of one huge bite. What do I mean? Well, people get excited when they come in here and they say, okay, well, how much money can I make if I do $100 on this contract at 2x leverage or 5x or 10x? Wow, if I just increase the leverage, I'm going to make a lot more money because I'm controlling a much larger portion of tokens. Of course, that lowers the liquidation. I mean, raises the liquidation. You're more likely to get liquidated if there's a market move. The other thing people will do is they'll say, wow, $100 for this contract. Well, why don't I do 500? Why don't I do 1,000? Look how much I'm going to make with 10,000. So they start doing bigger and bigger bets. So they're trying to get one huge bite. And if it goes south, that's dangerous. Look, if things just go up and to the right, you'll always be fine. But yesterday was a great example. Depends on when you're watching this, but the market took this huge dip. And crypto, like Arrow here, took, during that same time frame, it took about the same dip. What do I have this on a daily? It also dropped a significant amount. So if you had gotten in with a futures contract just a day or two ago, and all of a sudden it just did this huge wick down, you could have gotten liquidated. Now you're watching this on June 7th. It was June 5th when the market took this big drop. Then on June 6th, it started to come back. But on June 5th, when it took that huge drop, I saw some statistics that over 200,000 people were liquidated, meaning the prices had dropped so fast so far. Now, some people will say, these exchanges are manipulating the market. They see some bad news. They take advantage of it. They control the market and they get a wick down to liquidate people. Doesn't matter if that's happening or not. You just don't want to be liquidated. And if you're liquidated, you don't really care how it happened. It happened. So you have to be careful because obviously, and this is the reason I say I take smaller bites. And here's what I mean. If I look at Arrow, I might say to you, I believe, and I do, I believe it might reach $5. From 50 cents to $5 is a 10x. Okay, so I can buy it and get a 10x. That's my belief. But what if I use leverage of 5? Ooh, now I got a 50x? Hold on. I'm going to buy it with leverage. Now, if I do that, that's fine. And the price just goes like that. But it doesn't. It goes like this. And then it goes like that. Right? I mean, that's just how, look at the price movement, up, down, up, down, up, down. So that's how you're at risk. So I don't take a trade with futures thinking I'm going to get an exit price up here because of the quick. So what I mean by smaller bites is I'm perfectly happy with a 25% gain or a 50% gain on my money. If I make 25 or 50% on a trade because I bought it and it popped up, great. Like yesterday, when this market was tanking, when it started to turn around, it was last night when I took a risk. I guess it was probably, that's January 5th. It did start to go back up. I put in about 5 small futures contracts because I believed this was going to happen. And I'm about to get out of them because I have a decent small amount. It's when you get greedy. When you either increase the leverage, you're increasing your risk. You increase the amount of money you're putting toward that contract, you're increasing your risk. You tell yourself you're going to wait until it gets way up here to sell your futures contract, you're increasing the risk. I do what for me is a small amount with a small amount of leverage, and I try to get in and out very quickly. That's it. I hope that was helpful and explained essentially how leverage works. Whether or not you want to do it, totally up to you. But you got to make sure you know these cryptos that you're getting into fairly well. There's patterns you can look at and that sort of thing. But I just wanted to give you an idea of how it works in case you want to explore it further. Have a great day. Hope we can all make generational wealth together with crypto. Thanks for watching.